Before the tremors of 2008 rattled everything, a world of endless economic optimism believed the good times would never end. Houses soared, credit flowed, and innovation promised a golden age. But what if that colossal crash, the one that changed everything, simply vanished from history? What if the financial crisis never happened? And let's find the answer to the question, what if? In this alternate reality, the world enjoys an uninterrupted economic boom, extending the early 21st century growth phase far beyond 2008. Global economies thrive, fueled by elevated consumer confidence, persistently low unemployment, and robust spending across all sectors. The grim term Great Recession never enters our vocabulary, replaced instead by a decade of remarkable prosperity. Crucially, the housing market continues its steady ascent, its bubble remaining unpopped. Readily available credit and consistent demand prevent the widespread collapse of housing values and the devastating wave of foreclosures our timeline experienced, safeguarding household wealth and stability. Central banks, free from crisis response, maintain accommodative monetary policies, ensuring credit remains inexpensive and easily accessible. This fuels continuous investment, consumer borrowing, and even speculative ventures, all without the immediate urgent need for quantitative easing or near-zero interest rates as a desperate measure. Absent the 2008 crisis, the financial sector's regulatory landscape remains strikingly unchanged. Without catastrophic institutional failures, the urgency for sweeping reforms like the Dodd-Frank Act simply never materializes. Financial institutions continue operating under their pre-crisis framework, lacking new oversight. Consequently, complex, unregulated financial instruments, synthetic CDOs, credit default swaps, proliferate unchecked, their inherent risks unaddressed, and their market presence expanding significantly. This undisturbed environment also perpetuates a culture of aggressive risk-taking. With no painful lessons learned from systemic collapse, banks face minimal pressure to deleverage, and investors freely engage in speculative ventures. This complacency allows an even larger, more intricate web of financial vulnerabilities to accumulate, quietly growing beneath the surface without any significant challenge or reform. In this alternate reality, without the shock of 2008, public confidence in institutions remains robust. The pervasive anger and distrust towards financial elites and governmental bodies, so characteristic of our post-crisis world, never fully materialize. Instead, a greater sense of trust in economic systems and corporate leadership endures, shaping a more optimistic societal outlook. Consequently, political narratives diverge significantly. The rise of economic populism, intense debates over inequality, and the too big to fail dilemma fade. Movements like Occupy Wall Street, born from crisis fallout, simply don't emerge. Political discourse focuses elsewhere, potentially muting or altering the trajectory of certain anti-establishment figures. Globally, power dynamics are far less disturbed. The crisis accelerated the shift of economic leadership and the rise of emerging markets. Here, a more stable, perhaps complacent global economic order persists. The US economy retains a stronger relative position, and the urgency for new global financial governance is notably less pronounced. In a world without the 2008 crisis, innovation and investment would follow a decidedly different trajectory. With sustained economic growth and an absence of the recessionary shock, capital would continue to favor established, booming industries rather than shifting towards recession-proof or efficiency-driven ventures. This emphasis on scale and expansion over lean operations could mean fewer disruptive startups in certain areas. The pace of technological adoption would also evolve uniquely. Without a surge in underemployment, the gig economy might not have boomed as rapidly, and streaming services growth drivers could differ, without consumers seeking cheaper alternatives. Furthermore, a continuously thriving economy experiencing less immediate pressure on resources from a demand drop might slow the urgency for a rapid energy transition. Investment would likely lean towards traditional energy sources, potentially delaying widespread adoption of renewables and sustainable practices. The drive for innovation would still exist, but its priorities, pace, and focus would be fundamentally reshaped. Even without the seismic shock of 2008, underlying economic imbalances wouldn't vanish. Asset bubbles, excessive debt, and interconnected financial systems would accumulate, building a larger, more complex web of vulnerabilities. Economic cycles are inherent. A different crisis would eventually manifest. This could be triggered by an external shock, geopolitical event, natural disaster, a commodity price collapse, or a new asset bubble, e.g. corporate debt, tech sectors. Potentially later in the 2010s or 2020s, escalating globally globally due to unchecked risks. Alternatively, a softer landing is possible. Without the specific interconnected subprime mortgage vulnerabilities, accumulated stresses might unravel more gradually. This could lead to smaller regional downturns or a prolonged, less catastrophic global slowdown, allowing a more managed correction rather than a sudden, painful collapse. Uninterrupted growth post-2008 would reshape society, finance, and politics, likely deferring rather than eliminating systemic risks. In your opinion, what if the 2008 financial crisis never happened? Share your thoughts in the comments.